Hello to the first few folks who are joining us live here this afternoon or morning, depending on where you're joining us from in the country. My name is Emily Wetter. I am joined today by Dan Blake from UI Charitable. I am joining you from Holistiplan. We are so excited to be bringing you this webinar co-hosted together today to talk more about charitable gifting, especially when we talk about donor advised funds and how these two can be complemented or used together. So if you're talking with a client about a donor advised fund, utilizing UI Charitable, but also maybe Holistiplan to go through some of those tax consequences or tax opportunities, I should say. So we did have quite a few folks registered, very excited. Going to give it just a couple minutes here to let everyone get settled in. We are, as when you were joining, you probably have to choose like you allow or recognize that we're recording the webinar. So that's absolutely happening. And we will get that sent out probably by tomorrow, or at least within the next couple of business days. All right. We're still tracking a little bit up one by one, but I think for the sake of time and everyone's day, we are going to go ahead and kick off the webinar and get started. So once again, if you joined after I said some of the housekeeping items, my name is Emily Wetter. I join you from Holistiplan. I am a customer success specialist on the team. If you're a current subscriber, we may have already been in communication before. So hello, I might be a face to an email you've received. I am also joined by Daniel Blake from UI Charitable today. He will be going through a bulk of the webinar, talking about donor advised funds, working with UI Charitable, but then I'll be stepping in at a couple different moments to maybe going through how a donor advised fund and the tax opportunities that could present themselves when you might be even modeling something like that for a client using a software like Holistiplan. So with that, if you want to step in and take things over, Dan, happy to pass over the mic.
Yeah, absolutely. Thank you so much, Emily. Like Emily mentioned, my name is Dan Blake. I'm the CEO here at UI Charitable Advisors. We really view ourselves as a philanthropic back office for wealth managers, financial advisors, and family offices. And we are absolutely thrilled to be here today with all of you. Like Emily mentioned, we wanted to talk about charitable giving, the importance of incorporating philanthropy into your financial and legacy planning, as well as explain a few different tools and strategies that you can use. And then at the end, we're just going to touch on some of the specific offerings that we have at UI Charitable with donor advised funds. So jumping right into it, I do want to start with why charitable strategies matter, both for your clients as well as for all of you. So looking at this, 62% of clients, of investors, agree that it's important for their wealth advisor, their financial advisor, to understand their values. And we really see that playing out with their charitable giving goals. And so we see advisors that focus on clients' philanthropic goals see higher client retention, higher client ratings, as well as higher net promoter scores. And jumping into those details, starting with the net promoter score, this is from a study of 1,200 RIAs and family offices. And across the board, those that included philanthropic planning into their practice saw higher net promoter scores. So 7% higher when asked the question, I trust my primary financial advisor to make decisions that are in my best interest, 13% higher when considering their unique needs. And I think this one's the most interesting and the most compelling. Those that included charitable planning in their offering scored 27% higher when asked if they view their financial advisor as a multi-generational resource to their family. A few other stats that I think are really interesting: firms that include charitable planning on average have 6 times the assets compared to those that don't. They see 3 times the amount of organic growth and 1.3 times the amount of new money. So hopefully this just helps set the stage on why we believe it's really important to include philanthropic planning and different charitable tools in your overall financial planning strategies. And so the fastest growing tool that we see in the charitable giving space are donor advice funds. For the last 5-6 years, this has been the biggest trend in charitable giving and the fastest growing tool. Since 2020, contributions to donor advice funds are up almost 50%, and grants out of donor advice funds account for 14% of all charitable giving. The thing that I think is really interesting is half of high net worth individuals still aren't familiar with donor advice funds. So even though this is a really popular trend that we're seeing, it's still a really big opportunity for you and all of your clients. And so what is a donor advice fund, and why is this such a popular tool? And the essence of a donor advice fund is it's allowing you to separate 2 decisions: the timing of the tax deduction from a charitable giving standpoint from the timing of your charitable giving. When most people look to give to charity, they're combining these 2 decisions. They're giving when it's not necessarily optimal from a tax standpoint, and oftentimes they feel rushed because of taxes to decide what charity they want to give to. And so we're going to talk about the power of separating out these 2 decisions so that you can optimize for both of them independent of each other. One of the easier ways to think about a donor advised fund, I think, is comparing it to a private foundation. And we'll send these slides out so that you can go through the detail of all of it. But a couple of points that I want to call out. So functionally, a donor advised fund and a private foundation really act the same way. You make a contribution into the DAF or the private foundation. It qualifies for an immediate tax deduction. And then over time, you can give to different charities. So that's the general concept of a DAF and a private foundation. Donor advice funds, you can set up almost immediately. Take several weeks or months to set up a foundation. You have to file with the state. You have to get your own tax exemption. And if you look at this causes to support, you essentially have the exact same flexibility in a donor advice fund that you have in a private foundation. Anything that you'd want to support from a private foundation standpoint, you can really do all those same things from a donor advice fund. So from a flexibility standpoint, from a causes you want to support, they're on par with each other. Where this gets really interesting is if you look at the tax deduction and the valuations. So across the board, a donor advised fund is far more efficient from a tax standpoint. You have the 60% of AGI adjusted gross income with a donor advised fund of donations of cash, whereas you only have a 30% AGI limit with a private foundation. So your tax deduction's almost twice as high. That limit is twice as high in a donor advised fund. The donation of stocks in closely held assets, 30% in a donor advised fund compared to 20% in a private foundation. But the real kicker is in a donor advised fund, all assets are valued at the fair market value. In a private foundation, that's true of public stocks, but all other gifts, the valuation of the gift, the value of that tax deduction is done at the cost basis. So you get no benefit from any appreciation of those assets. And this is really the main reason why we see the trend of people closing their foundations and moving those assets into a donor advised fund. And if you look at the versatility of donor advised funds, they can be used in estate planning when you have big liquidity events, retirement planning. If someone's donating to multiple charities, donor advised funds are an incredible tool just to streamline all of the reporting. It provides a tremendous amount of flexibility in timing to grants to different charities. The other benefit is your giving through a donor advice fund, if you would like, can be anonymous. You can do it through the name of the host of the donor advice fund instead of disclosing your own name. Whereas if you're giving as an individual, all that information is going to be public. If you're giving through a family foundation, that information is also public. So we're going to jump into two separate strategies that you can use with a donor advice fund. First one's charitable bunching, and it's a strategy that's really applicable to most of your clients. We're then going to get into a slightly more niche strategy of that's going to be more applicable to higher net worth individuals. It's going to be more applicable to entrepreneurs and business owners. But starting with charitable bunching. So charitable bunching is this concept of timing your donations, taking multiple years worth of donations and front loading them into a single year to maximize your itemized deduction. And then in future years, you're not making any additional donations and you're able to claim the standard deduction. So it's really an arbitrage between maximizing the itemized deduction and continuing to optimize with the standard deduction. So we have a quick case study. So we're going to look at one scenario without charitable bunching and then look at the differences if you were to approach this from a charitable bunching standpoint. And again, this is really looking at charitable giving if you are optimizing from a tax standpoint. So looking at the timing of your giving. So let's assume you are working with a married couple and they generally are donating $15,000 a year to several different charities, whether this is their church, their university, the soup kitchen down the street. So they have that $15,000 a year that they're donating. So over a 5-year period, that'd be $75,000 worth of donations that they're making. And then they're going to have other deductions, state and local taxes, their mortgage interest. And so their total yearly itemized deduction, let's say, is $31,000. So it's just slightly higher, just over $3,000 higher than the standard deduction. So the total donations over 5 years is going to be that $75,000. The total tax deduction, because they're itemizing that deduction every year, is $155,000. So now let's look at the exact same scenario, but let's change the timing of their giving. So with charitable bunching, so we're going to take the $75,000 that they would have given over 5 years, and we're going to put that all into a single year. So in year one, they donate $75,000 to their DAF. That money can now grow tax-free in the donor advice fund, and over the next 5 years, they can give that money away to the various different charities. They still have the state and local taxes, they still have the mortgage interest deduction, but now the total itemized deduction is $91,000, significantly higher, over $60,000 higher than the standard deduction. In years 2 through 5, they're not donating that $15,000 anymore, so they're going to be below the standard deduction. They're just going to claim the standard deduction of $27,700. So the tax deduction in years 2 through 5 of just taking advantage of the standard deduction is over $110,000. So the total donations over that 5-year period, again, is just $75,000. We're not changing the amount that they're giving, but by changing the timing of when they're giving, the total tax deduction has increased by over $50,000, up to just over $200,000. So without charitable bunching, the additional tax savings over that 5-year period above and beyond that standard deduction limit is $16,000. With charitable bunching, just changing the timing of their giving, that increases to over $60,000. So you have a 3 to 4x multiple in the overall tax savings over that 5-year period by simply changing the timing of their giving. This is the power of a donor advice fund. It allows you to optimize for the timing of your giving from a tax standpoint. And then over time, you can continue to support the various different charities that you'd like to. So I'm going to turn the time back over to Emily to walk you through how you can model this in Holistiplan.
Yes, thank you so much, Dan. I am going to start sharing my screen here. Are you seeing that now? Should be my Homer and Marge Simpson scenario. Can you see that, Dan?
Yep.
Perfect. So if you are working with a client, and in this case, for comedic purposes, I used Homer and Marge Simpson to model charitable bunching. And we'll get to in just a moment if they were to gift and maybe gift like something of a little larger value to a donor advised fund. But in this scenario, Homer and Marge, they are in our baseline scenario here. If I scroll through, maybe you want to take what Dan just said and you've been talking through this with a client, you want to put more of a personable touch on their particular tax circumstance, that's where we can take the story into something like Holistiplan. So now we've talked through conceptually, gotten the client really excited about that donor advised fund situation, bunching that gifting strategy together. But how does that look for, in this case, Homer and Marge, right? We want to bring that closer to home for them. So we can enter in their respective situation estimated for 2024. If I scroll down here, donor advised funds from a how-to standpoint entering into the software, super simple. We're going to focus on our Schedule A itemized deductions, just like Dan was going through on his side in the PowerPoint. And in this situation, we have that $15,000 here. And in fact, I don't even have represented some of the other items that Dan was talking about, so it could speak even more specifically to the situation. But simplistically, we're focusing on 15,000 gifted to charity. They're taking the standard get to reap a benefit of that gifting strategy, but then we talk about that bunching strategy, right? The gifting that they're always doing year by year, what if we just put that into 1 year? How would that look? So taking the 5 years of gifting into one, this just becomes 75,000. How would we enter either the 15 or the 75 in Holistiplan? How to charity? You click on your charity worksheet, and we're just focusing on, when we are speaking about DAFs, good to remember that language from the Internal Revenue Code will say to a 50% limit organization. That's indicative that it's to a donor advised fund. And so here, I know that verbiage is a little goofy, but it comes right from the IRS. So when you are entering it, though, into Holistiplan, you want to focus on 50% limit organizations, respective of the type of gifting you're doing. In this case, I just chose cash. But when we speak to another strategy coming up, we're actually going to switch this to a capital gains donation. We will also be identifying the different limitations on each of those. So Dana had mentioned this, but like 60% AGI limitation per that Tax Cut and Jobs Act on a cash donation, 30% AGI limitation on like a capital gains donation situation. But in this case, just focusing on that 75,000. If we were working with Homer and Marge, right, we're talking through that bunching strategy. We want to point out what is that savings here. If you start at the very top, nothing else is changing between their scenarios until we get to that Schedule A, an increase of 60,000 for the bunching. And then here, that's going to show that increase for the current year on the itemization. So now they're itemizing at 75,000, dropping their taxable income by just over 45,000, ultimately saving them that $16,000 in that current year of planning. And if you even wanted to take it a step further, what Dan was that, if you modeled out the next 5 years in Holistiplan, we could show the client what bunching all of the charitable gift in 2024 versus now we're going to go back to taking that standard deduction for 25, 26, 27, etc. It will even take into account the Tax Cut and Jobs Act coming up for folks for tax years 2026 and later. So you can get really specific and make this really close to home for the clients that you're working with. And I'm going to bump it back over to you, Dan.
Awesome. Thank you.
Yeah.
All right. So this second strategy, we're going to use the example of a private business sale, but this strategy is really applicable to any highly appreciated asset. And so we'll go through another case study. So let's assume we have a family, it's an entrepreneur, business owner, and they're selling their business for $10 million. and they're interested in being charitably active. And so they have decided that as a family, they would like to set aside $2 million from this sale for their charitable giving. So we're going to look at 3 examples really quickly. And again, we're just going to be looking at the timing of their giving. And so the first thing to be aware of, if your client has no interest in charitable giving, they don't want to support their school, local charities, their church, a donor advised fund is not for them. If their only goal is to maximize money in their pocket, they have zero plans of being philanthropically minded, they should not set up a donor advised fund. So you'll see in this no donation scenario, this is the scenario where they maximize the amount of money in their pocket. They're not giving anything away. But if we look at these other 2 scenarios, you have the donation after the sale versus the donation before the sale. So donation after the sale, you have that sales price of $10 million. They started the company, so they're going to have a really low cost basis. Taxable amount, say $9.9 million. They're going to pay $2.6 million in taxes. Their after-tax equity, $7.3 million. At this point, and this is unfortunately when most people give, they're making a donation after the sale of $2 million in cash. Their final equities, $5.3 million. They do qualify for that gift tax deduction. It's the $2 million. If we assume a 44% tax rate, that's going to be $880,000 saved in taxes. So the final equity plus tax savings is $6.2 million. So now let's just change the timing of their giving. Instead of giving cash post-sale, let's donate a portion of the business in kind prior to the sale. And again, this can be done with any highly appreciated asset, whether they invested in NVIDIA a long time ago, that's appreciated a ton. They're invested in cryptocurrency, they have a private business. So sale price of $10 million, they donate $2 million of the equity of the business to the donor advised fund. You still have that really low cost basis of $100,000, but so now the taxable amount is $7.9 million. The portion that was donated to the donor advised fund is not going to be subject to capital gains because it's in a nonprofit entity. So we've lowered that taxable amount. So the taxes are now $500,000 less. Instead of 2.6 million, it's 2.1 million. Your after-tax equity, 5.8 million, but you're not making a donation post-sale. So this after-tax equity and your final equity is going to be the same amount, 5.8 million. You qualify for that same gift tax deduction. You made a $2 million donation of equity instead of cash. So you still get the $880,000 in income tax savings. But because you avoided paying the capital gains on the portion that you donated, the final equity plus the tax savings is $6.7 million compared to that $6.2 million. So by simply changing the timing of that gift to before the sale, you're saving $500,000. I mean, that's pretty incredible. I'm going to turn the time over back to Emily to walk us through how we could model this in Holistiplan.
Yeah, thank you. All right. You guys should be seeing my strategy once again, working with Homer and Marge Simpson. But this time, maybe Homer got a little bit of a raise from Mr. Burns out at the nuclear power plant. So he's doing pretty well now, him and Marge, or both of them are. And their gifting strategy looks a little bit different. So in this case, we're talking about the sale. So the gifting of a piece of real estate that they have, it's a sale then to then taking that cash gifting to the donor advised fund versus what if we just gifted that real estate directly to the donor advised fund. So going to show you, and I modeled this out. I was in charge of modeling it, and I was surprised by the results of just switching around how we're gifting, right? You're going to see the tax savings. It's incredible. So in this particular scenario, we have a real estate, so they're selling it. So they have a capital gains here, long-term capital gains, $400,000 off the sale of, in this scenario, I assumed a $500,000 gift. They had basis of 100,000, kept it pretty easy, $400,000 here on the long-term capital gains side. And that's why you see here 400,000 capital gains, but not on this, because if we're gifting it directly to the donor advised fund, we don't have that sale then taking the cash. We're just gifting it right over there. So that's the difference here. It also impacts how we're itemizing this. So because we have an $80,000 tax liability from the sale of that $500,000 piece of property, that actually will produce a little bit of a different dollar value as far as what we're gifting to the donor advised fund. And in this sense, it is a cash donation to the 50% limit organization. We talked about that before. So $420,000 here. Versus if they're gifting it direct to the donor advised fund, they get to take that $500 fair market value, gift it right to the donor advised fund. So they have even more, from a charitably inclined place to gift more into that DAF. And how this would be represented is a little bit different, just because that is now going to be a capital gains donation, still to a 50% limit organization that will have a 30% AGI limitation attached to it. Just remember that we can gift a little more. In this circumstance, it was designed so that these AGI limitations did not necessarily come into play. They're able to take the full $500,000. Whereas you might be working, a realistic case could be that someone is bumping up against that AGI limitation and you might have some carry forward. So if I just made this, so this is just a note. I think if I made this, I'm bumping this up way high. So see how it says calculated deduction 607,000 of this $1 million capital gains donation gift or gifting a piece of real estate. It will, in the software, actually just tell you what the carry forward amount would be if we were going to then be looking at 2025. So I could take this 392 amount, we'll call it out right here. If I add a scenario, I can just copy this over. And if I said this one, I would change this up a little bit, of course, but all I need to do is then take that 392, 112 here. And now I'm taking that in 2025, identifying how this is a carry forward for that new year of planning. And I would simply just change this to 2025. And we might have some income changes to note up here when we are working in Holistiplan or for the client, but pretty simple to model these types of scenarios. So they seem like really complex. These are big numbers, etc. But I think, in my opinion, pretty easy to break this down here with the client. But I'm going to bump this back down to 500,000 just so you all can see, because when I scrolled through and got to this number, I was like, oh my gosh. So just because we changed how we were, instead of selling it and then we're just directly gifting it, save them almost $125,000 in taxes. And we simply just changed how we gifted it. Almost like a QCD, right? We're going to gift from the IRA versus from the bank account. We're going to gift the piece of real estate versus selling it first. All right, back to you, Dan.
No, thank you, Emily. So I just have to reiterate how easy this is to model in Holistiplan. I mean, it really is incredible how easy it is to walk the client through these different steps. So hopefully you all understand why a donor advised fund is so compelling. But I do have to say, not all donor advised funds are created equal. Our goal at UI is to give the most flexibility possible to both the donor, your client, as well as you. And so our DAF is different than most other DAFs in just the general flexibility that we offer. So we have the skills and the expertise to accept both simple and complex assets. So if you're looking at highly appreciated assets, whether that is a private business, whether that's real estate, whether that's cryptocurrency, we can manage those donations. And then once the asset is in the donor advised fund, one area where we are really different than most other donor advised funds is we have no minimums. So on $1, the financial advisor is able to manage the assets in the account. And those accounts look like any other accounts that you're managing. So you are able to use the same investment strategies. You're able to use, you're able to choose your preferred custodian. You're able to bill against it the exact same way that you'd bill against any other account. So we have our open architecture that just allows you to manage this account just like you would any other account, really allowing for a much more consistent level of management, which benefits both you as well as your client. And then we also have just greater flexibility in who the donor can donate to. So we allow for both domestic and international giving, as well as grant giving and impact investments. So again, really anything that you could accomplish through a private family foundation, you could accomplish through a donor advice fund at UI Charitable. So just to quickly recap the benefits of a DAF, you are separating out two decisions. The decision of when is the best time to give from a tax standpoint so that you can optimize for that, from the decision of who do I want to give to. And by separating those two, you're able to optimize for both. And when you donate to a DAF, you receive that immediate tax deduction. Because this is such a flexible tool, it's the easiest way to help clients fulfill their philanthropic goals. And because of that, again, just a really incredible tool from a legacy standpoint. The two strategies that we talked through, charitable bunching. This, again, is relevant to just about any of your clients. Again, one of the great things about UI not having any minimums, we have donor advice funds as small as $5,000. This is a great way of helping people introduce them to the world of charitable giving. And then we also have DAFs that are tens of millions of dollars. And again, the strategy that we talked about with highly appreciated assets, private businesses, real estate, cryptocurrency. And again, just to hit on these 3 points one last time, what makes us different? We accept a wide variety of assets. Essentially anything your client would like to contribute to their donor advice fund, they can. Our open architecture giving you more flexibility to manage the assets in the donor advice fund. And again, perhaps most importantly, greater flexibility in giving so that your clients really can accomplish whatever their charitable goals are. And with that, that covers everything that Emily and I wanted to go through. Thank you so much for your time. I think we have a couple of minutes to answer questions. I don't know if there are any specific questions that have come up that we should address.
Yeah, Dan, there's a few that I would suggest here. One question from Randy is UI Charitable able to accept non-traditional assets like real property, or would the property need to be sold and UI accepts the cash?
That's a great question. Generally, we can accept real property. There are additional steps that we will want to review. The IRS does require a third-party appraisal on real property greater than $5,000 to establish the fair market value. So the short answer is yes. The more detailed answer, we should get in touch just to make sure that we understand the details of the asset and make sure that both you and the client understand some of the additional requirements that the IRS has.
Great. And another one, are you able to move the DAF from a different platform to UI Charitable if it is already in existence?
Yeah, that's another fantastic question. The answer is yes. All donor advice funds are required to be public charities. And so you transfer from one DAF to another by simply making a grant to that new DAF. It's no different than issuing a grant to the local Boys and Girls Club.
And a couple of people have asked, what custodians does UI Charitable support?
Another great question. All of the major custodians, Fidelity, Schwab, Pershing, it's a long list. I would imagine anyone that you are working with, we have a relationship with and have accounts with them.
Great. And there's also been a couple of questions about QCDs, comparing and contrasting using a DAF versus a QCD, how those interact. Can QCDs go to DAFs? Kind of just how do they relate to donor advised funds?
Yeah, so they really are separate tools. There is a carve out. QCDs cannot be sent to a donor advised fund. They have to be sent to an operating charity. There are other DAF-like vehicles, general field of interest fund, a community fund, that QCDs could go to. But the goal of a QCD is to get it as quickly as possible to an operating charity. So they're not allowed to be sent to private foundations or donor advised funds.
Great. And a couple of questions have also asked about if you can add a little bit of clarity to differentiating the UI Charitable DAF versus a Schwab or Fidelity Charitable, how you would summarize in 2 to 3 points the key differences.
Yeah, so using Fidelity Charitable, just because they're the single largest donor advised fund platform out there, using them as a point of comparison. Fidelity Charitable requires you to custody the assets at Fidelity. They then have a limited number, depending on the account size, they have a limited number of investment options that you can make. They also don't allow you to assign a financial advisor to the account unless I believe they have $100,000 minimum before you can assign your financial advisor to the account. And so at UI, we have no minimum. On $1, the financial advisor is able to manage those investments. Whatever investment platform you're using, whatever investments you would like to make in the normal course of business, you can use the donor advised fund assets to make those investments. There really aren't any restrictions there. And again, our open architecture allows you to choose your preferred custodian. So if you want to keep the assets at Fidelity, fantastic. If you'd like them at Schwab, Trade PMR, Pershing, all of that's welcome at UI.
And
all right, I think we're probably up against time, but thank you so much for spending your afternoon with myself and Emily.
Yes, thank you, everyone. And just as a housekeeping reminder, we absolutely recorded this webinar, so we will be sending that out along with a copy of the slides that Dan went through today. So you will have that in your inbox probably within the next couple of business days. But thank you so much, Dan, for going through that. I had so much fun, partnering with you guys on this, and hopefully, maybe current users or prospective users out there also saw some value in how we can combine that DAF and Holistiplan pairing. So thank
Yes,
you.
thank you so much.
Yes, well, everyone, you have a wonderful rest of your summer days. I'm up here in Michigan. There's blue skies outside that I've been looking at all day here. So I might go out there for a walk, enjoy some of that summertime in Michigan. That's what we live through all 20 months of winter for up in the north. Well, we'll see everyone. Thank you for joining us.